So here's the deal. Hedge funds are everywhere. In the news, in movies, probably messing with your pension. And yet, 99% of people have no clue what they actually are. They sound mysterious, powerful, a bit evil. They're whispered about like some secret weapon used by ultra rich people to quietly take over the financial world. And honestly, that's not entirely wrong. Imagine a casino. Now, imagine that casino is in a skyscraper, surrounded by Bloomberg terminals, and every bet is made with someone else's money. That's a hedge fund. Alright, let's cut through the finance jargon. A hedge fund is basically a pooled investment fund, like a mutual fund, but with less regulation, more freedom, and a whole lot more risk. Instead of your mum investing in one through her bank, hedge funds are invite only, high roller tables. You need serious cash to get in. Think millions, not thousands. They're typically structured as private partnerships, which means they don't have to tell the public what they're doing. There's no daily price ticker, no friendly app, just a bunch of people making extremely complicated bets behind extremely expensive doors. The word hedge originally meant protection, as in they'd hedge against losses. You know, balance risky moves with safer ones, but fast forward a few decades, and most hedge funds today don't hedge anything. They go all in. Long bets, short bets, sideways bets, quantum physics bets, whatever might make money. And who runs them? Usually a small team of hyper competitive, spreadsheet slinging math freaks who somehow convinced billionaires to trust them with billions more.
Trust me.
You gotta trust him. Look at those eyes.
You call that cute?
Okay, so what do hedge funds actually do to make money? 1. Long/short equity. This is the bread and butter. They buy stocks they think will go up, and short stocks they think will tank.
Picking stocks is a lot easier when you already know what's going to happen.
Shorting, by the way, is basically borrowing a stock, selling it high, and hoping you can buy it back later for cheap. It's legal, it's risky, and when it backfires, well, just ask Melvin Capital.
I think my stock just dropped.
2. Leverage. Translation, they borrow a ton of money to make bigger bets.
I love money.
Why make a $1 million bet when you can borrow $9 million and make it a $10 million bet? If it works out, boom, massive profit.
I see that you're going to come into some money. A lot of money.
If it doesn't, boom, massive crater.
I love you, buddy, but you are lost.
3. Derivatives and options. These are contracts based on other assets, like making bets on bets. You can speculate on interest rates, currencies, even weather patterns. Seriously, there are hedge funds that bet on hurricanes, not metaphorically, literally weather. 4. Event-driven strategies. Think a company's about to merge, split, or file for bankruptcy. Hedge funds study these events like hawks and pounce when they see an edge. They might buy one company and short the other, all based on what they think will happen when the news hits.
Sharon, you've been watching CNN for about 8 weeks now. Don't you want to watch something else?
5. Quant strategies. This is where the robots come in. Quants, quantitative analysts, build algorithms that scan the market for microscopic patterns. They trade based on numbers, not vibes. If humans are driving cars with instinct, quants are racing Teslas on autopilots. And yes, sometimes into a wall. But all of these strategies have one thing in common. They're not designed for safety. They're designed to maximize returns. Fast, big, and ideally before regulators even know what happened. And the wild part? A lot of this money isn't even theirs. Hedge funds are often playing with money from pension funds, universities, foundations. You know, grandma's retirement, your cousin's student loan endowment, the art museum's emergency Picasso fund. So yeah, it matters.
Subscribe to the channel.
Please like and subscribe.
Alright, so now you know what hedge funds do. But the real magic trick isn't in how they invest, it's in how they get paid. Meet the 2 and 20 model. It's simple, it's brilliant, and it's kind of insane. They charge a 2% management fee just for watching your money sit there. Doesn't matter if they're up, down, or daydreaming about buying a yacht, that 2% is locked in. Then, and here's where the fireworks start, they take 20% of any profits they make for you.
What the hell are you talking about?
Made you $100 million? Cool, they keep 20 million. Lost you 100 million? Oops, they still keep the 2%.
It's my money.
Now, let's talk about what happens when hedge funds go full beast mode and actually move entire markets. Exhibit A, George Soros. A name that's either legendary or villainous, depending on your political leanings. In 1992, Soros bet against the British pound, shorted it, with billions in leverage. He was right. The UK had to pull out of the European exchange rate mechanism, and Soros walked away with $1 billion in a single day. The British government, less thrilled.
We may destroy this government one day after all.
Then there's GameStop, a modern classic. A bunch of hedge funds, most notably Melvin Capital, bet that GameStop, a failing retail chain, was going down, but then the internet happened. Reddit's army of retail investors pulled a reverse Uno card and pumped the stock sky high, nuking the hedge funds in broad daylight. Melvin lost billions. Retail traders celebrated like they'd just beat Wall Street at its own game.
The market will bounce back.
Spoiler, many of them lost their shirts later, but the moral victory, priceless. And let's not forget Archegos Capital, which used insane leverage on tech stocks via something called total return swaps. Don't worry, we're not going there, and managed to wipe out $20 billion in a week. Banks were left holding the bag, and Archegos, gone. Poof.
What am I running from? The negativity. It keeps trying to follow me.
The point is, hedge funds have that kind of power. They don't just play the game, they change the rules. Let's be honest, hedge funds don't have the warmest public image, and that's not just because they drink oat milk lattes while moving markets from their Manhattan penthouses. There are a few reasons people love to hate them. One, they win on both sides of the disaster.
Oh no, I loved them both.
Markets go up, they profit. Markets crash, they profit. Two, they're barely regulated. Unlike banks or mutual funds, hedge funds operate in the shadows with minimal oversight and even less public reporting. They're basically a Batman of finance, if Batman charged 20% and broke currencies.
What's my location?
3. They take big risks with other people's money.
It's not just money.
That means your pension fund, university endowment, or foundation might be part of some highly leveraged play that could go nuclear. And when they blow up, they don't go quietly. They drag down banks, partners, and even national economies. But the top guys usually walk away with their bonuses and their private islands. Over the past decade, the average hedge fund has underperformed a basic S&P 500 index fund. Why? Because markets are efficient, and expensive strategies with high fees and aggressive bets don't always translate into consistent wins.
All right, can you please explain to me what's going on?
Funds like Renaissance Technologies, Medallion Fund, the stuff of legend, have posted insane returns. We're talking 30 to 40% annually over decades. But here's the catch. It's closed to outside investors. You can't even try to give them your money.
Why are you the way that you are?
Then there's Bridgewater Associates, run by Ray Dalio. Massive, famous, respected. But still hit or miss depending on the year. Even the best hedge funds have bad quarters, bad years, and strategies that age like milk. And remember, they're taking 2% no matter what. So even if they barely match the market, they're still pocketing millions from fees while you celebrate breaking even.
You know, I look around this room and I see failure.
So no, you don't need to become a hedge fund bro. You don't need to read The Economist in a cigar lounge or learn what Sharpe ratio means, but you do need to know they exist, that they're out there, making billion-dollar bets on things you didn't even know were tradable. Water rights, weather futures, theme parks in Singapore. Because in today's economy, hedge funds aren't just behind the scenes, they're stage managing the whole damn show. What are hedge funds, bro? They're power, risk, brains, ego. And sometimes, chaos in a tailored suit. If this helped, you finally understand what hedge funds actually are, or at least helped you fake it better at parties.
Thank you.
Do us a favor. Hit like, subscribe, and maybe even share it with someone who still thinks shorting is about not getting enough sleep. More financial mysteries decoded, coming soon.